Well, you've likely seen in the news recently the GOP's 429 package pays tax plan called the Tax Cuts and Job Act. The big question is, what would that mean to you and your retirement?
Here to help this morning is Jim Heafner. He's the president of Heafner Financial, and he's known as Carolina's retirement coach. Jim is a certified financial planner and best-selling author. He joins us every Wednesday to help us get financially fit, and we're so grateful you do. Jim, good to see you.
Good to see you.
Mm-hmm. Okay, first off, what would President Trump's newly proposed tax bill mean for high-income earners?
Well, let's start off by saying that if you're a high-income earner and you work with us, hopefully you already have your plan in place. And what we've done for you won't be impacted by any of this stuff. If you have a great tax plan in place, like a Bill and Melinda Gates or Warren Buffett, that kind of plans that these guys have, these changes don't impact you at all. But otherwise, yes, it's going to have an impact on you. So be clear that the major impact of this proposal is to slash taxes for large corporations. Next, for business owners. Right, so if you're a high-income W-2 employee, probably raise your taxes.
So when you say high income, what threshold are we talking about?
When you pass over $400,000, a lot of things happen on annual income. So we look at that as being a reasonable number to consider you high income. You're paying more taxes at that number typically. So it's worth a real strategy for you. Mm-hmm. But if you're high income and you're W-2 working for somebody else, because deductions and exemptions go away, probably paying more taxes, not less. Now, if you're a business owner, you have a sub-S, a partnership, an LLC, probably you'll benefit from the tax structure. The real three commonly talked about changes are, one is the increase in the standard deduction. That's smoke and mirrors. Deduction goes up, but your exemptions go away. Same thing, not a change at all. The other one is the elimination of itemized deductions. Now, that's a big deal because that means your property taxes you can't deduct.
Yes.
Your state taxes you pay you can't deduct. Medical expenses you can't deduct.
So all that's hurting the average American, if I'm not mistaken. Because
really,
the average American, you pay property taxes, you're doing that stuff and your charity stuff, and you're trying to deduct that from your taxes.
Surely middle income and above, it does hurt. You know, the low income, perhaps not. But they're also not going to be helped by the standard deduction change either.
Okay, so let's talk about the seniors that standard deduction. I understand it may double, that standard deduction may double. What does that mean to an average American tax?
Really nothing. So the standard deduction now for a couple is $12,700 per year. But you also get two exemptions, one for each of you. That's $4,050 each. So now you're at $20,800 write-off, right?
Yep.
Well, when that standard deduction rises to $20,000, your exemptions go away. Was that a change at all? Not really.
No.
It doesn't make a difference.
Okay. Well, let's talk about this also. They're going to supposed to be repealing the estate tax. What does that mean if you repeal estate tax for, the death benefit that you have to pay taxes on? So is it eliminated? Is it maintained? Is it status quo? What does it mean for regular people?
We're not sure. They first said they're going to double the exemption, the threshold. Now they're saying it's going to go away. The bottom line for the average American, it makes no difference at all. In fact, there are very, very few people who ever pay estate taxes. First of all, you have to have over $11 million between you and your spouse to do it.
Yep. But
even if you have billions, you can easily eliminate that by using trusts. People who pay estate taxes are not paying attention. That's that simple, right? But so if that goes away, no big deal. But if the step up in basis goes away, and that's the trade we're talking about, if they get rid of the estate taxes, they may eliminate the step up in basis. Now, what that means is if you bought a stock for $100 and over your lifetime it grew to be worth $1 million, all that's taxable to you.
That's taxable to you.
Right? Yep. But if you die and pass it on to your kids or spouse, it's tax-free. That basis, your cost stepped up to current market value. So it's a way of passing money on tax-free. But that's used by everybody. All income levels can benefit by the step-up in basis. If that goes away, that's really significant for America. Well, I don't see it happening, but who knows?
So when the taxpayer bill was proposed, will it give the investor a boost that what Trump is proposing?
The investor a boost?
Well, yes.
I don't think so. The real question to me is, will it do what it's intended to do, and that's to stimulate the economy? And I don't think so. So when these things happen, tax cuts for the corporations, it said, well, that will boost the economy. It's never happened before. It doesn't typically work. And the situation we're in now as a country is our debt's pretty darn high.
We got a high debt.
But if taxes do drop for corporations, it's going to increase our debt more and more, meaning future pressure on our economy. I don't think it's a good thing for us. Now, if taxes do drop, take advantage of it, do raw conversions, but don't count on that's going to help you at all. Probably won't help you.
Well, let Jim and his team help you with your retirement planning. If you'd like to learn more, call right now for a free copy of Jim's book, Retire Tax Free. It's available for the first 5 qualified callers. The number is 704-552-1230. You must have a minimum of $500,000 in investable assets to qualify. Again, the number to call, 704-552-1230. Or you can visit Jim's website. It's you'lljustknow.com. You see it there on your screen, you'lljustknow.com. Jim Heafner, thank you so much for being here today.
Thank you, sir.
Again next Wednesday.
All right.